Welcome to Lesson 35, T3 Lesson 2 on position sizing. Even if you find a great entry on a Bitcoin daily chart like the one on screen, the same habit you'd use reading S&P 500 or NASDAQ levels, sizing the bet badly can blow the account in one trade. Today we cover three things. The rule that you can lose only about 1 to 2% of the whole account on any single trade, a simple formula that turns that rule into size, why you should bet conservatively and small. Great technique without sizing is useless. Ordinary technique with disciplined size lets the account grow over time, through Fed shocks, earnings weeks, and quiet grind alike. Drop a comment. I want to learn position sizing. Position sizing means deciding in advance the most you can lose on one trade. The base rule: set that loss limit at 1 to 2% of the whole account. Example: with a $1,000 account, you allow at most $10 to $20 of loss on a single trade. Then you exit at that level. Think of it like budgeting a $3 coffee habit: small, fixed, and non-negotiable. %. Do the math. Under a 2% rule, 10 losers in a row cost about 20%, so roughly $800 remain. Bet 10% a trade, and 3 losers drop you to about $730. If capital remains, you can keep learning and stand back up. No capital means the game is over, whether you're trading Bitcoin or watching them NASA. So how many units should you actually buy? There's a simple principle. When the stop distance, the price width you're willing to lose if you're wrong, is tight, you can buy more. When it's wide, you buy less. Stop width and size move in opposite directions. If you risk 2% of the account from your entry level, and the stop is only 1% wide, you can take a larger size. Stretch the stop to 5% wide, and the same 2% dollar risk means size must shrink to 1/5. Same idea whether the chart is Bitcoin or the S&P 500. How to place stops comes in the next lesson. For now, lock this in. The farther the stop, the smaller you buy. Math textbooks have something called the Kelly Criterion. Example: if a trade wins 60% of the time, pays 2 to 1 when you win, and loses 1 unit when you lose, Kelly says risk roughly 20% of the account on that edge. In live markets, you should use half of that or less, deliberately conservative, because the past doesn't trap the future. Markets don't move like a textbook, and a Fed day can rewrite the script by lunch. Historically, news, liquidity shocks, and technical breakouts have overturned prior analysis more times than traders like to admit. The 2008 financial crisis and the 2020 COVID crash are classic cases. So you always size small with the thought, what if my analysis is wrong? People who bet big struggle to recover from one wrong call. People who keep the 1 to 2% rule have, statistically and historically, far higher long-term survival rates. Big account or small account. The 1 to 2% rule is the same. Keeping it when you start small is the key to long-term survival. Example: a $500 account means you allow $5 to $10 of loss per trade. Bitcoin, stocks, futures, same principle. Size is tiny, but the account stays protected, like stretching a $3 coffee into a $4.50 world and still living inside a budget. At first, the small size can feel frustrating. Traders who keep the rule minimize damage and grow the account slowly. As the account reaches $1,000, then $2,000, the same 1 to 2% rule lets you buy larger size. That is the power of compounding, the same force long-term S&P 500 investors rely on. What is the real goal of position sizing? Not profit, keeping the account alive. Think it through. From $1,000, 10 losers under the 1 to 2% rule still leave roughly $810. Someone risking 10% a trade is down to about $730 after 3 losers and nearly wiped after 10. Brilliant analysis with broken sizing still wrecks the account. Weaker technique with solid money management compounds upward. Textbook and history both back this, including how accounts that survived 2008 and 2020 lived to trade another decade. With capital left, you have time to learn and a chance to recover from failure. Next lesson, stops and take profits. Quick recap of T3 Lesson 2. Remember 3 things. Risk only 1 to 2% of the account on any one trade when the stop is wide. Shrink the size move at half Kelly or less, and you survive longer. Next up in Lesson 3, stops and take profits. The rule for where you exit once you're in. If this helped, please subscribe and hit like. This lesson is for education only, not investment advice. Every trade is your own responsibility. See you in the next lesson.